we saw the bond yields rallied, so which implies again there was a mild dip in the bonds, and also currency sharp depreciation seen yesterday. So now let's understand what are the cues looking like, and for that let me welcome Sandeep Agarwal, the Senior Fund Manager, Fixed Income, Sundaram Mutual Fund. Sandeep, good morning and welcome to the show. What's your reading from the bond market perspective, from the RBI policy, and how it's going to look like? So far the trend has been again go overweight on short-term tenor. Again, long-term tenor was slightly relatively underweight, and then also we were seeing strong rally in the bond market. But post RBI policy, how is it looking to you?
Morning, everyone. See, basically, market went into the policy in the anticipation of a 25 basis point cut as a done deal, and along with that, there's a possibility of 50 basis cut as well. And apart from that, market was also expecting that MPC will also change the stance from neutral to accommodative. Obviously, that didn't happen, and MPC only delivered in terms of a rate cut, which was the expectation from the larger set of market participants. But non-delivery on in terms of the 50 basis point rate cut or the change in the stance, and over and above, if RBI would have given some guidance in terms of the liquidity in the market. That was also missing from the statement as well as the post-policy press conference. So that led to slight selling, rebalancing of portfolios and positioning because the expectation didn't deliver. Otherwise, policy was quite balanced. And if you look at the path going ahead, we believe that now again the market will shift its focus back to the monsoon, the crude prices, the vegetable prices, which has been the fuel and the food has been the main reason for this lower inflation print. And if you look at the path ahead for inflation, is largely based on these two factors, and this is an expectation because the core inflation still remains on the higher side in the 5 to 6% band, which is not a very comfortable situation to be in. So any surprises in crude or food prices, can dent these projections. And RBI also stated these risk factors in the policy statement as well. Apart from that, they did mention about the fiscal situation, which is quite clear. It's ballooning, and knowing any exact situation on that would be difficult before the new government comes in place and presents the full budget for the year, which will happen sometime in the July. So I think in terms of looking ahead, I think June policy cut also, to my mind, looks a bit, less likely event, and most likely that could happen in sometime in August when, the RBI will have more data in terms of, how the monsoon is panning out, the food inflation,
right.
The crude prices.
So Sandeep, I would want to interrupt you over here.
Yeah, sure.
Now, we've spoken about the domestic cues, but the way the US yields, Treasury yields are panning out, and we have seen a slide on that front. What is the impact that you're seeing from the global side of business as well on the bond yields? Where do you see them settling at in the near future?
Sure. See, in terms of impact of global markets or the bond yields in the developed economies. See, if you look at it, that is, the expectation on the overseas is, Fed may even resort to cutting off the rates instead of, the earlier projection where we were thinking that, they will be continuously going for hike, for another 2 hikes in 2019. But now the dot plot chart is saying, no hikes. And even some market participants are saying, there may be even a possibility of a cut, and some slack in the economy is visible. And if you look at it in the policy also, it is clearly mentioned, that there is one place that slowdown, can drag the growth.
Sure, Sandeep, allow me to interrupt you and ask you, since markets will be opening. So let me ask you this question also. From where the bond yields are right now, do you expect sort of move towards 7.2, 7%, or you expect a sort of 7.6%, or we are going to be largely sideways? Like, what sort of expectation you are carrying at present, especially when the flows into debt market has been very strong?
at present, we believe the bond yields that, in terms of 10-year government benchmark yield, we believe it will trade in the range of 7.25 to 7.5, unless because there is a huge supply ahead, and which will keep the bond yields higher. Along with that, if there is any OMO announcement or additional liquidity pumped into the market, then this can improve. Otherwise, we believe the yields are going to remain volatile and on the higher trajectory in this band.
Right. Sandeep, thanks a lot for coming on the show and sharing your insights into this important follow-up move. I think which the markets are going to watch out. If the bond yields don't show any major spike, then perhaps there is not going to be any reason again for the sort of a banking setup to see any sort of nervousness, primarily because then treasury income will remain intact. So the word is, we actually are going to remain in the range 7.2 to 7.5. I think that's what I think the bond market actually is going to find some stability. 2 minutes to go, and now let me welcome Milind Sharma from Rivergate Capital. Milind, good morning and welcome. One word, any theme which you're liking at present, let's talk